Welcome to The Explainer. If you've ever pulled your hair out wondering why the market perfectly respects one zone but completely obliterates another, you are in exactly the right place. Today, we're demystifying smart money concepts, specifically order blocks. But look, we aren't just sitting around talking theory today. We are breaking down what actually works using real, back-tested data. I'm absolutely thrilled to get into this with you because by the end of this explainer, you're going to have a highly structured, concrete playbook for identifying those high-probability trading opportunities and cutting right through the noise.
All right, here's our roadmap for today. We'll be hitting the fundamental rules of order blocks, checking out the real backtesting results, hunting down structural patterns that actually win, dialing in the best market conditions, and finally, executing with lower time frame confirmations.
So let's jump straight into part one, the rules of order blocks. We've got to filter out the junk.
Because let's face it, not all order blocks are created equal. Just to make sure we're on the exact same page, let's define the core concept here. In smart money concepts, an order block is considered the last candle that created an inefficiency in the market. Whether that's kicking off a massive impulse move or sitting right in the middle of a trend, this candle is literally the footprint of big money. It represents a critical zone where major institutional decisions are made.
So how do we actually validate that footprint? Well, you need this non-negotiable three-step checklist. Step 1, the move has to create inefficiency. We are looking for drastic, violent moves that leave massive, clear gaps between the candle shadows. Step 2, the move has to lead to a break of structure or a change of character. That's the market giving us a huge clue about whether it wants to continue a trend or reverse. And step 3, which is absolutely crucial, the zone must remain unmitigated. Order blocks are strict, one-time use zones. We only care about the very first time the price taps back into that area. If it's already been touched, we scrap it entirely.
Moving right along to part 2, the backtesting results. Time for the cold hard proof.
To see if these rules actually hold up in the wild, our source tracked exactly 100 setups specifically on the Euro to US dollar 1-hour chart, using Trader Edge to log everything. The setup? A standard $10,000 initial account. They capped the risk at exactly 2% per trade, aiming for a 4% profit. So we're talking about a strict 1-to-2 risk-to-reward ratio across the board. This is super important because mathematically, even with just a 34% win rate, a trader would completely break even.
Now, here's where it gets really interesting. Check out how those 100 trades actually played out. 28 of those setups never even triggered. The price simply didn't return to the unmitigated zone, so they were canceled. But of the ones that did play out, 41 setups ended up hitting the stop loss, while only 31 hit that 1-to-2 profit target. That leaves us with an overall win rate of literally just 43%, with the account experiencing a max drawdown of 10% during the test.
Now, if you're sitting there thinking, wow, a 43% win rate sounds absolutely terrible, you can take a massive breath of relief right now. Because despite losing way more often than winning, sticking to this strict order block strategy, combined with that ironclad risk management, actually grew the initial account by a massive 47%. That is the absolute holy grail of trading right there. You do not need to be right all the time. Your winners just have to outpace your losers. Period.
Which brings us perfectly to part 3, structural patterns that win. Let's optimize those entries.
By digging into the data, we can actually score our order blocks to filter out the low probability traps. For example, you want to subtract a point if you see a gap and another valid order block sitting directly below your target zone. Why? Because you know how the market is. It will absolutely blow right past your first block just to grab the liquidity to fill that lower gap. On the flip side, give a setup plus 1 point if the order block itself swept liquidity from equal highs or lows. That sweep is like rocket fuel. Finally, be on high alert for the retail support trap. If you see retail traders building obvious support lines right above your zone, realize their stop losses are sitting directly underneath. Smart money will inevitably push the price down to grab those stops before finally tapping your valid block.
Let's do a quick psychological check-in right here, straight from the source. A losing trade does not automatically mean your analysis was flawed. No strategy is going to work 100% of the time, simply because we cannot control the market. Just stick to the probabilities and do not let a red trade shake your discipline.
All right, part 4, best market conditions. Let's talk about the environment.
Because honestly, even a flawless setup will tank if the market environment isn't cooperative. The data clearly points to where the highest probability environments live. You really want to focus on midweek trading. Mondays and Fridays notoriously suffer from low liquidity, which leads to super messy price action. You also want to execute during the London and New York sessions. Order blocks need explosive volatility, and those off-peak sessions just don't have the juice. Finally, stick to low spread pairs like the Euro-US dollar. These setups demand precision, sometimes reacting within a single pip, and a high spread will literally cause you to either miss a perfect entry or get stopped out way too early.
So the crucial point here is that context is everything. Order blocks have a significantly higher success rate when traded in the direction of the dominant market trend, rather than trying to fight the chop in a ranging market. Also, fresh order blocks are just vastly superior. Supply and demand is a constant tug-of-war. If you wait 3 weeks for a price to tap an old order block, chances are the market sentiment has completely shifted, rendering that old zone useless. Fresh is always, always better.
And that leads us to our final section, Part 5, Lower Timeframe Confirmations, the actual execution.
Now that we've found our fresh, high probability, higher time frame zone, how do we actually pull the trigger without getting wrecked? We employ the 2 time frames lower rule. Once you spot your order block on a higher time frame, you zoom in exactly 2 steps for your confirmation. If your zone is on the 4-hour chart, your entry happens on the 15-minute. If you found it on the 1-hour, zoom in to the 5-minute. And if you're trading a 15-minute zone, your entry triggers on the 1-minute chart.
Once you're zoomed in, here is your exact chronological playbook. Step 1, you sit on your hands and wait patiently for the price to finally mitigate or tap that higher time frame block. Step 2, you do not just blindly enter. You wait for a change of character, a CHOCH, on that lower time frame to actually prove the market is reacting. And Step 3, based on what that change of character looks like, you choose the appropriate entry pattern.
And this brilliantly illustrates the 2 distinct branching paths for your entry. Pattern 1 happens if that lower time frame change of character leaves an inefficiency gap behind. In this case, you place your order a spread size above this new micro order block, put your stop loss below the zone, and you can even trail it under new higher lows for massive risk-to-reward ratios. But what if pattern 2 happens, and there's no gap left behind? Easy. You draw a Fibonacci tool from the start of the change of character to the end. Set your entry right in that golden pocket between the 0.618 and 0.78 retracement and drop your stop loss safely below the swing low.
Let's bring this all together. We started off by seeing how even a modest 43% win rate yielded a staggering 47% account growth simply by sticking to strict 1 to 2 risk setups. So I'm going to leave you with this thought to wrap up our explainer today. If you take this exact structured playbook, the strict rules, the liquidity patterns, the time of day filters, and those hyper-precise lower time frame confirmations, how might strictly applying this logic transform your own risk-to-reward reality? The back-tested data is sitting right there. Now it's time for you to hit the charts and test it yourself. Thanks so much for joining me on this explainer, and happy studying!